Hello, good afternoon. I welcome you to EST 411. Actually, slides 1 to 4. I have attended to the preliminary requirements explaining what we need to do and the modules that are involved. For example, slide 1 is just a descriptive thing. You have drawing of books there showing that you have to prepare very hard for this course. Module 2 is also talking about the online lectures and what semester it is and the course code, the course instructor. Slide 3 is talking about what you need to do for further reading. You need to get that Kuye valuation textbook, Property Valuation Techniques, a Practical Approach by Dr. O. Kuye. You need to get hold of that to help you in this course. 4 is talking about all the modules. I think there are 4 of them or thereabouts. Then 5 is where we are going to start from. Now, which is module 1. Slide 5 is module 1. And module 1 is going to talk about nature and effects of premium. So we start from slide 5. What is premium? A premium is a lump sum of money paid by a lessee to a lessor at the beginning or during a lease for the grant of a renewal of lease in consideration for a reduction in rent or for some other benefits. Let me break this down. Premium denotes a lump sum payment made by a lessee to a lessor, and this could be made at the beginning of a lease or during a lease so that a renewal of a lease can be granted and there must be a reduction in rent. The premium is usually fixed at a figure less than the true rental value of the property. Because if the lump sum payment is to facilitate a reduction in rent, then the actual rent passing must be below the true rental value. So there must be a profit rent to be enjoyed by the lessee. That is what it means. Once the lessee pays a premium, the rent must be reduced so that the lessee can enjoy a profit rent as a gain to him for going into that venture. And what does premium cover? That it covers improvement works, expenditure which can be undertaken by the tenant during the lease term. It does not necessarily mean a transfer of funds. It could be agreed by both parties that the tenant could do certain improvement works or carry out some expenditure which we consider as payment of a premium, or it can actually be a sum paid, a lump sum paid for the purpose of a premium. But the important factor to note there is that there must be a profit rent. The lessee must enjoy a profit rent, and that profit rent should be the capital value, should be capitalized to get a premium. The premium is derived from the capitalization of the profit rent payable by the lessee. Then, when is this premium? When does it usually occur? It occurs when there is a strong demand for properties, and owners of properties are trying to raise money to do other capital things or maybe invest in other things. So, having said that, there are 2 points of view that must be looked into in this kind of deal. The tenant will have his point of view and the landlord will have his point of view as well. When this deal is sealed, there are 2 points of view. Usually there must be 2 points of view. To the landlord, premium will provide a lump sum cash gain for him, but a reduction in income. He can get a lump sum money which he can divert to other businesses, but he must be rest assured that his income will be reduced. We'll continue in the next slide. Again, when you look at it critically, it appears that the landlord is selling part of his future income for a lump sum. That's how it appears, because if there's a reduction in rent, if there's a profit rent, that profit rent is what is selling for a lump sum which he gets immediately, and that profit rent is his future benefit, because he's not getting the profit rent today. It's profit rent that's accruable in the foreseeable future, which is being capitalized, and it's taken as a lump sum today. That's the other way the landlord might look at it, as if he's selling for a lump sum present capital sum. To the tenant, it appears that he's losing a capital sum, because he's the one paying to the landlord, to the lessor. It appears as if he's losing a capital sum in return for a low rent which he's going to pay. Actually, he's not losing. He's paying the capital sum for the difference in the rent which he ought to have been paying. So he's not really losing. That's why I put the loss in quote and unquote, because he's buying a profit rent for himself in the process. So he's not losing. But we are just trying to conceptualize this. What the tenants might be thinking is losing, and what the landlord might be thinking is doing with that transaction. Then how does it work? Now, the parties may agree first on the proposed reduction and then fix a calculated sum as premium. For instance, if the reduction they are looking at is 500 naira or 5,000 naira, they may say instead of the rental value being 40,000, pay 35. Then there's a profit rent, assuming that they are on the same terms anyway, net basis or gross basis, before you can deduct directly like that. Otherwise, you might necessarily be required to deduct outgoings first and bring them to the same level before you can get the difference. So you may need to agree first on the proposed reduction. So if you are agreeing first on the proposed deduction, the premium will be a capitalization of the 5,000 agreed reduction. Then that converts to a lump sum which you pay, and a reduction of 5,000 naira is agreed. It's straightforward enough. Or they may decide on the capital sum to be paid, and that can be broken down into how much reduction he can get per annum to make up his profit rent. I take that again. The parties may first agree on the reduction, say 5,000 naira reduction. So instead of paying 40,000 naira rental value, he pays 35,000. The remaining 5,000 is the profit rent, which is capitalized to determine the lump sum, that is the premium that will be paid. That's why I said calculated. It has to be calculated, because no party must lose in that transaction. It is not meant for any party to lose out in that transaction. So it will be calculated like that. Or they may decide on a capital sum to be paid. Okay, we want 50,000 to be paid as premium. How much reduction should be given so that when capitalized by YP for the unexpired term, it will come to 50,000. They can also do that. There are two ways that can be made to work. Can be made to work in two ways. Calculation of premium. The calculation of rent or premium can be made from the landlord's and the tenant's point of view. Since there are two basic points of view which were highlighted before, the landlord is likely to be focusing on the premium because a lump sum and a lump sum cash which he receives, while the tenant is likely to be focusing. That's like summarizing the 2 points of view, the two perspectives. While the tenant may be focusing on the reduction in rent he is going to achieve, because it's going to be easier for him to be paying the rent anyway. So the calculation of the rent or premium can be made from the point of view of both of them, and in each of the cases a different answer will likely emerge, because which a compromise figure may be agreed. If you are looking at both parties together, then you better look at their points of view and try to find a compromise point for them. But if you are looking at the tenant's point of view, well, look at the tenant's point of view and value from one aspect, the tenant. If you are looking from the tenant's point of view, value from the tenant's point of view, because the tenant will be interested in reduction and the rent is going to pay. The landlord will be interested in the premium. So in other sense, what we are trying to say is that the valuation problem will take two forms. One, what premium should be paid by the lessee in consideration for a reduction in rent. This is likely to be from the landlord's point of view, because he's always looking at premium. What's the lump sum he's going to get? Maybe he's anxious to go and marry or do some other things. Then secondly, the other one is likely to be from the tenant, because he wants to know how much reduced rent he will be paying after he has paid this lump sum. It's actually by compromise. There is no compulsion there. There is no force there. They are not brought together by force. They come together to agree and reach a compromise. So where the question asks you for the tenant's point of view, please value from the tenant's point of view. Where it's asking you what premium, that's the landlord's point of view, value from the landlord's point of view. If it's asking you how much is to be agreed, value from both the tenants and landlord's point of view and find a compromise, an average of the two, and say probably that represents a fair rent that should be paid or a fair premium that should be paid. So it's very important to note this. Very, very important. In view of what we have said so far, I want us to broaden our view a little bit and take these two notes that I've highlighted to enable us get a fuller understanding. In general, a premium could entail the loss of part of the landlord's income. I said before that the tenant may feel a sense of loss because he's paying a capital sum. The landlord also may feel a sense of loss because he's going to be getting a reduced rent. So, and that a tenant may consider the reduced rent a gain to him. So we have to broaden our view. It's not a straitjacket. It depends on the perspective of the landlord, and the landlord may feel that he's a loser, going by the fact that his income is going to be reduced. The tenant may feel he's the loser because he's going to pay a lump sum. So it depends. But actually nobody's losing. Nobody's losing in real terms. So in general, a premium entails the loss of part of the landlord's income ultimately, because he has to take a reduced rent, and gain on the part of tenant ultimately, because the tenant will get a profit rent. The amount of premium should be calculated so that each party is virtually in the same position as if the full rental value were to be paid. So no party is supposed to lose. So present interest will be equal to proposed interest. That's a normal equation. It's an equation that can be taken for granted in premium. So present interest will be equal to proposed interest because they are to be in the same position as if the full rental were to be paid and received. Consequently, the determination of premium to be paid or rent to be fixed should be done from both parties' point of view. That is the first thing we should note. We should get into our heads that no party is operating at a loss, and generally the calculation should be done from both parties' point of view, except the question states specifically otherwise. So there are some working formula I want you to understand and commit to memory. From the tenant point of view, the tenant is always looking at the profit rent. So it's going to pay a lump sum, which is called premium. So it looks at the profit rent, multiplies it by YP, and the premium is calculated. The annual equivalent of the premium or the annuity owner you purchase is also referred to as the profit rental in this case. So the profit rental will be the annual equivalent of the tenant's gain annually. Now, so annual equivalent is calculated as premium over YP, and for the term of lease or for the unexpired term, depending on when it was taken. If the premium was paid at the beginning of the lease, it will be YP for the entire term. If it was taken during the lease, it will be YP for the unexpired term. So the annual equivalent in this case is the profit rent or the reduction in rent, which the landlord is always interested in, because he thinks the tenant thinks it's a gain to the landlord. The landlord thinks it's a loss to him because he's taking something less. But by and large, annuity is equal to 1 over YP. And profit rent in this case will be premium over YP for the term of the lease. Now let's look at this worked example, the very first one. Estimate the premium that should be paid when a lessor granted a 30-year lease of a shop at a rent of 20,000 with a 5-yearly revision at 80%, revision to 80% rental value. The full rental value is 25,000 per annum. Tax at 35%. Now, if we look at the right side, you will find the solution there. This question suggests that we should estimate the premium that should be paid when a lessor grants a 30-year lease. It did not say that the premium that the lessor is expecting or that the lessor should pay. It just said that the premium that should be paid. So that presupposes that you have to value from the perspective of both the landlord and the tenant. That's the first thing you have to decide. You decide upon that, because the question did not say value from the premium that the landlord should expect or that the tenant should pay. It's saying just get a premium. So it must be premium as agreed by both parties. So let's look at the answer to it. So we first take the tenant's point of view, or you take the landlord's point of view, whichever one is convenient for you. If you take the tenant's point of view, the present rental value, going by the question, is 25,000. We are assuming that it's on the net basis. It's on the same basis with the other one. Rent to be paid under the lease. We are assuming that you have brought them to the same basis. So future profit rent will just be a matter of deducting 2 from 1. That is 20,000 from 25,000. So straightforward, you get future profit rent to be 5,000 naira per annum. The lease is 30 years and it is granted the premium is to be paid at the beginning of the lease. So subject to a 5-year revision, that does not really concern you, because what the beginning is of concern to you. Subject to a 5-yearly revision. So YP 30 years at 8/3 or 2.5. Tax had specifically stated that tax must be taken at 35%. Why is it dual rate? It's dual rate because it's a tenant and it has a limited tenure in which he has to provide for the recoupment of his capital to enable him continue elsewhere. I believe we know the principle. Then premium from the tenant's point of view will be 48,850. That's 5,000 times 9.77 YP. Now from the landlord's point of view, the landlord is supposed to, the present interest of the landlord, 25,000. That the present interest, the landlord without the premium is supposed to take the rental value of 25,000 and is supposed to take it in PEP at 7. Well, if the market yield we're assuming is 7%, it's supposed to take it in perpetuity because the freeholder is supposed to take it in perpetuity. When the 30 years expires, it is assumed that he can still let it at 25,000 and it continues. And secondly, the landlord does not need to set aside a sinking fund. So it's straightforward single rate. So you get 357,000 from there. His proposed interest rent for term now is constricted to 20,000 per annum because that's the reduced rent he will receive having taken a lump sum. Then YP 30 years, he has taken a lump sum, so the YP will be for 30 years at say 7%. That gives you that. Then after the 30 years, he has a reversion to full rental value, which is 25,000. So YP in PEP for 7 years times PV, we have to divide it. You can get 25,000 in perpetuity, but he has to wait for 30 years. Times PV will be equal to YP of a reversion to a perpetuity, deferred 30 years, which will be 1.88 times 25,000 will be 47,000. And if you then you now add which is 295,200, you know, 295,200, that is 248,200 plus 48,000 will give you 295,200. Add premium, you don't know the premium. That is what you are trying to find. If you look at the question, premium has not been given to you. That's what estimates the premium. So premium will be taken as X. Now it will be 295,000 naira 200 plus X. And our principle is that present interest must be equal to proposed interest because no party is expected to lose. So present interest, which is, if you look up, you see it's 357,000, is equal to proposed interest. Proposed interest is 295,200 plus X. X will come out to be 61,500. Now, if you try to find the average, I think it will come to about 60,000. That appears to be the average between the tenant's point of view and the landlord's point of view. The tenant's view suggests 50,000 and the landlord's view 60,000. A compromise would be needed to arrive at the premium. So you can just find the average. You know, that puts paid to that. It's so easy. The only area that appears to be clumsy there is, in fact, no area. The fact that I will receive the income of 25,000 in perpetuity is so clear. It's so clear in principle and practice. You know, so because his present interest is that he can get 25,000 in perpetuity. He's only limited in his proposed interest on account of the 30-year lease which is granted to the lessee. So please look at this example. It's a very basic and simple example, and that will foster a further understanding of the principles of premium calculation. Thank you. Please take a look at worked example 2 and a deeper look at the solution to be able to digest the issue of looking for rent to be fixed by both parties. A grants a lease for 30 years to B of a modern complex office block containing 450 square meters of effective floor space in a select position. B is to spend immediately the sum of 137,000. You remember that I told you premium need not necessarily be cash paid, lump sum paid to, it could be amount agreed to carry out some extension work, repairs and so on, so which is taken in lieu of the premium. So it is set in this case to construct a boundary fence for building and garages at the rear, comparable office let at 80 naira per square meters on FRV basis, and produces a freehold return of 6%. Advise both parties on the rent to be fixed. This is the other side of the question. You are either looking for the premium or rent to be fixed from the two perspectives of the parties involved. So please look at this solution cleverly and carefully so that you can understand it better. The rent to be fixed is usually less than the market value, so that you can have a difference which we call the annual equivalent or the profit rent, or rent to be paid by the tenant. So take note of this principle and see how you can apply it to solve this problem. Thank you. Yeah, worked example 3 also has to do with what rent is to be paid if a premium has been paid. So ordinarily I will not bother. I will just expect the students to look at the solution on the right side and try to see how right the solution is in such a way that will further their understanding of the subject matter. But why I'm talking about this slide is because of the notes 2 that we have under. We treated note 1 before, so I felt we have to talk about note 2. And it's not something entirely new, it's what we have been discussing before. I'm just emphasizing it right now and here. Note 2. The calculation of the premium or rent follow the same approach generally. That is, considering from both points of view, unless academic exercises dictate the use of either the tenant's point of view or the landlord's point of view only. So, in which case, you have to decide what the question is trying to ask you. Whether you find, if it's rent to be paid anyway, that has to be from the tenant's and landlord's point of view also. So there is no difference. You should calculate both from their view, because they have viewpoints of what should be paid either by way of rent or premium. So unless the question says from one party's point of view only, that's when you restrict yourself to that. Otherwise, you have to go for the both parties and now find the average. So I've overemphasized that. The second point is that we should note, and worked example 4 is the one that is going to show it how that is done. It should be noted that future premium is to be discounted at the remunerative rate from the landlord's point of view, who is receiving it, whereas tenant's point of view, it's a future liability and it should be discounted at the accumulative rate. This is to be treated under capital sums receivable in the future. But I'm mentioning it now because under worked example 4, it is going to be applied. If the premium is not immediately payable, it's payable at a future date, the receiver, it will be at a discount rate, remunerative, discount rate remunerative, because he is receiving it. The landlord is receiving it. He is receiving it to improve his lot, the lot of his property, to enhance the value of his property. The tenant is paying it as a matter of compulsion. Probably it has been inserted in the agreement and it has become a liability. So he has to set out a sinking fund. So that will be taken at the accumulative rate of 2.5% or 3%. This is worth noting. We must note this. It's important. That's why I'm taking special cognizance of it here. The landlord is receiving, so is at the accumulative, is at the remunerative rate. That's the market derived rate. The tenant is paying, he is under compulsion to pay. It's an agreement that has been executed, so it is assumed. So he must set aside some funds to be able to meet this liability, because it has become a liability and he has to pay it. This will be reflected a little bit, but will be considered, if you have not already done it in the lower classes, it will be considered under capital sums receivable in the future. Because if a capital sum is receivable and it has to be paid as a liability, it will be taken at accumulative rate from the tenant's point of view and at remunerative rate from the landlord's point of view, who is receiving it. The person who is paying is under liability to pay. The person who is receiving is under no liability, but is receiving to enhance the value of his property. That's all I want to mention here. Please look at the solution and see how it solves the problem. Thank you. This rent, the worked example 4, is unique in a certain sense because it's trying to calculate the rent to be paid by the tenant from the tenant's viewpoint, and the premium is payable in some years' time at a future date. So it is different, slightly different from the others when you are looking at it from the tenant's viewpoint. Now let's look at the question. A tenant has been granted a 14-year lease of premises having a net rack rental value of 2,000 naira per annum. The tenant has agreed to pay a premium of 3,000 in 5 years' time. So this premium is not to be paid immediately. It's to be paid at a future date. Calculate the rent per annum that the tenant should pay. That's from the tenant's point of view, assuming a yield of 8% and a tax liability of 14 kobo in a naira. Now look at the solution. First and foremost, the tenant is not paying immediately, he's paying in 5 years' time. So, and your calculation is based as at today. So you have to bring the value to today's value. You have to multiply it by the PV of 1 naira in 5 years, so that you can bring the premium to today's value. That's the first note you must have. And when you are doing that, it is compulsory for the tenant to pay this premium, because it has formed part of his agreement, has agreed to pay. So it must be part of maybe it has been put in the agreement that he must pay. and once it is in the agreement, it has become a liability. And once it has become a liability, you have to provide a certain fund to be able to meet this expenditure in 5 years' time. That is the investment principle. So if you look at the answer, you will see that net rack rental value is 2,000. Now reduction in rent, which will arise as a result of the premium he has agreed to pay, and he's not paying the premium immediately, he's paying it in 5 years' time. That will imply that you first multiply the premium by the present value in 5 years at 2.5 or 3%. So the value of the premium today is 2,652, as you can see. Then you now find the annual equivalent of that 2,652. Also, because it's a tenant and it's on lease, YP 14 years, lease is for 14 years. And it's assumed he has just taken the lease. 14 years. Now 14 years at 8%, which is given, and 2.5 or 3%, 2.5 or 3% sinking fund rate. Tax at 40. That the question says tax must be at 40 kobo in a naira, which is tax at 40%. Now you get the annual equivalent. You now deduct the annual equivalent from the net rack rental value to get what rent he should pay now. Likewise, it is possible to divide the payment of premium into more divisibles. Say in 5 years' time, in 10 years' time, he will also pay this. So you have to calculate individually, add together and deduct from the net rack rental value to find the rent that he should pay now, today. So please note that is what I want to mention. It's a deviation from what we have been doing, and it makes it more advanced somehow. So note that when you are determining rent to be paid, from the tenant's point of view, it is a liability. And if he's not paying it immediately, then you have to defy it. It's a liability, so you must apply the sinking fund rate, not the remunerative rate, but the accumulative rate of 3% or 2.5%, which is the sinking fund rate. Then you will have made allowance for that premium. You will have made allowance for that premium to find out the annual equivalent of that premium. So please note that, remember that, it's very important, because it has become a liability on the tenant. Now it's no longer an issue of ordinary agreement. It has become a liability to pay it in 5 years. So your rate must reflect it. If you are using YP, it must be dual rate because it's a tenant. And if you are using anything you are using, if you are using PV, it must be at accumulative rate, not remunerative. It's important. When a tenant has a liability to pay a premium at a known future date, he may provide for it by investing. I try to explain it again. An annual sinking fund, the rate of interest for investment to provide the capital sum should be a low risk rate. That is at an accumulative rate of interest, such as 2.5 or 3%, as you may decide to use. Thank you.